Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. Today's video, we're just going to be going through CoveredCall ETF Canadian performances through a Google Sheet I created called the CoveredCall ETF ALLSTAR Tracker, which, if you're interested, you can pick up for yourself inside my Patreon. It'll be in the description below or the very first comment that you see. Also, too, just as a reminder for those, on June 15th at 9 a.m., there's going to be a live Zoom session where I go through the tracker and how to use it, and that will be followed up by a Q&A if you want to participate in that. So head over to the Patreon for that, and just keep in mind that come July, the tracker takes a big upgrade. It's going to become a live tracker, so that's something I'm currently working on in preparation for that. So with that being said, let's get into the video. All right, so let's now look at Canadian performance. Let's look at Canadian performance data, and let's see what we can take away from what kind of opportunities there are right now in the Canadian landscape across different sectors, and just things that are interesting of note. So as you can see here, I got 1 week performance, 1 month, 6 month, year to date, and 1 year performance. This is only price performance alone, and it does not include total return. Now, total return is going to be added on the next month's tracker because I'm shifting over to a live tracker where basically all these numbers are going to change like basically every 20 minutes or so when that happens. So right now, currently, 3-year and 5-year are the only total return tabs or columns, I should say, that I got going on right now. But the newer funds are continuously coming online, and we need to be able to see total return in much shorter time chunks. And this is actually something you guys have been bugging me about. I wouldn't say bugging, but just like I have actually behind the scenes, even before you guys were mentioning wanting total return, I was trying to find ways, but basically Google Finance only does total return with mutual funds. So it's been a little bit hard to try to nail down a spot where I can extract that data from. But anyway, with all that being said, that's all going to change in the July tracker. So let's go over just the performances over the past week. Everything should be down, minus, I guess some of these funds. What do we got here as far as 1 week? The last trading week of May, with the biggest jump coming from Nvidia. Quite surprising, actually, and it probably came in the last hour of the trading day. On the last trading day in May, on the last hour of trading, the market just spiked in a big way. Like everything was down for the whole week until that last hour. Let's go over to, actually, you know what? We'll go down to what has been suffering over in the last week. HTAE, this is a technology favorite of mine, and so it suffered pretty brutally this week. It also has leverage, so again, whether it gains or whether it declines, with that 25% leverage incorporated into it, it just will have more of an ability to fall or rise, depending on whatever the market's doing. Over the past month or so, since we're still down here at the bottom, that shouldn't be green, but nonetheless, I'll get that changed out back over to red. So over the past month, not the biggest decreases, a little bit from energy, as we can see here. Energy, what else do we got? Some diversified funds in there. And then as we go to the top, over the past month, Nvidia, no surprise here. The single stock ETFs, again, where there's more concentration, like a single stock has more of an ability to just outperform by leaps and bounds. Okay, so these funds by purpose ETFs is just one. It's just one thing inside of it, right? With Ether and Bitcoin, it's just one thing inside of it. Now let's head over to 6 month. Now I like to use the 6 month window as really the spot where we can find true opportunities. 6 months to me is what I would refer to as like our economic window. If you're looking for opportunities over the last 5 years, we've been in so many different economic cycles with interest rates and inflation and COVID and geopolitical activity. There's just a lot going on over a long period of time. So we want to try to take opportunities in, I would say, in a time frame that is not exuberant, maybe say over the past week or the past month, right? There could be exuberance over the past month or so, but over 6 months, you get more of the big picture without it falling into a couple of different economic cycles. So we can see that the best performers are once again the single stock ETFs and the Bitcoin and Ether stuff. But where we want to look for opportunities is way down at the bottom here. What sectors are currently suffering at the moment? Now, why Tesla by leaps and bounds is another single stock ETF. Like we said, concentration. If the market's up, you're doing well. You feel like the smartest guy in the world, but probably maybe not necessarily as much when we see a single stock ETF like why Tesla go down by 37%. Now, hey, if you believe in Tesla and what Elon Musk is doing and all that good stuff and for the long haul, then hey, 33% could be an awesome pickup. It could be an absolute steal right now, depending on where their just what that vision is for that company and what its earnings are and all the rest. So over the last 6 months, let's go over to sectors. That's what I like to do. I like to filter it by 6 months and then just go over to the fund category and see what funds are, or I should say what sectors are just kind of hurting the most right now. Because as we know, in any economic cycle, there are winners, there are losers. What are the losers right now? Well, bonds has been kind of at the bottom over the last couple of trackers. It seems to be the most consistent sector that is suffering. So if you maybe have an idea that sector funds like bonds are going to be, they could rebound in a good way, then that could be a decent pickup there. I just think with bonds, the reason why you're not seeing more of these funds kind of maybe move towards the middle as far as performance is concerned, I think people are still kind of feeling a little unsteady with the economy. And bonds is just a good reflection of that, right? So do people believe that in the future their money will get paid back? Maybe that plays a part into it. I mean, bonds are meant to be that guaranteed return if you invest in them directly. Now, in this case, there are cover calls on them to get us these much higher yields. But what is the most likely sector to do well? I mean, probably first and foremost, tech. I mean, tech always does, just goes berserk when there is froth and exuberance in the market. But I would say, yeah, the underdog probably that nobody wants, but probably has a chance of making a rebound probably is the bond sector. Also, as we can see, utilities, just of course very much correlated with interest rates. We got ZWU. We also got, what else do we have here? Huddle and where's UMAX? UMAX is usually down at the bottom of this list. Oh man, I know I'm there it is. Okay, and UMAX. This one's in my portfolio. I really like UMAX, and it'll give you a nice 14% yield, whereas ZWU 8%, Huddle with 25% leverage gives you 8%, but UMAX actually has no leverage on it, and it invests 100% in Canadian utility companies. So you'll get railroads, you'll get pipelines, you'll get telecoms, you'll get traditional utility companies like Fortis and Emera. So just all around, I just like UMAX for its diversified industry. So let's put it this way, right? We can break funds down by sector, but we can break the sectors down by industries, right? So under every sector will be a multitude of industries that can make up the utility sector. And UMAX, in my opinion, has a really well diversified bunch of industries, of companies inside of UMAX. And you get an awesome yield to boot. It's about 50% coverage on the fund. And anyway, that yield, over the last two trackers, it has eclipsed. It was in 13% range for the longest time, but now it kind of holds steady in the 14% range. So, in my opinion, not a pretty good pickup there, especially maybe with some of these bond ETFs. H-bond is a pretty popular fund by Hamilton ETFs, gives you a respectable, well, I mean, for a lot of people who follow high yield stuff, 10% maybe doesn't feel as amazing as maybe it used to. To me, it's amazing. So you get a pretty good 10% yield, 10.5% yield with that. So that pretty much wraps up, as far as performances. I guess we could go through year to date, what sort of funds have been. But it's basically the exact same stuff. Since we're heading into June, the 6-month and year to date window are almost overlapped in that regard. And then, well, you know what we'll do? Let's just go, just for kicks, let's just go to the 3-year total return and see what some of these companies have returned, total return year. So we got ENCC over the past 3 years returned. If you just reinvested your distributions, you would have gone over 100%, which is like awesome. That's like an average of whatever, like 40% a year. Really good there. Some of these other funds in a 3-year window, great performance, really. Some of these tech funds price-wise have, if you just invested maybe just tech, yeah, you could probably outperform. But again, if you're looking for income, but also see greenery all over your portfolio, over the last 3 years, you would have done pretty well in that regard. So that pretty much wraps it up for Canadian CoveredCall ETF performances. Let's head into US listed performances. So we'll go over to the US tab over here, and we are gonna look at, we'll look at the 1 week performance, which is, again, it's going to be the concentrated stuff. Anything that's concentrated, you could honestly make up your own diversified fund by investing in just a bunch of these Yield Max ETFs. Now, they do have YMAX, which is their all-in-one ETF if you want that diversification of all these funds. But no surprise here that you get this kind of outperformance. Now, let's just be clear about something. What we're looking at, P2P, is just price performance. There is no total return until you get over to the 3-year and the 5-year tab. So price performance plus dividend. But a lot of these funds have not come out. They haven't been around for 3 years. So total return will get incorporated into 1 month, 6 month, year to date, and 1 year come the July tracker. So we can actually see, have a better bird's eye view, especially with these really high yielding type of funds. So let's go down the list of, in the last trading week of May, what has actually performed well. But it's mostly the single stock ETFs that have outperformed well. The worst being, again, another single stock ETF, which is mRNA. Over the last month, we got some significant performance from Maxi, the Bitcoin Strategy Plus ETF, and NVIDIA. More single stock performance. But, what's the very first diversified fund? IQQ, let's see. Almost 5% over the course of 1 month. It's also a newer fund by ProShares. If there's any diversified funds in the last month that have done well, it'll be more geared towards the NASDAQ, no doubt. Okay, so as we head down 1 month, see what funds have actually done well in the month of May. We also look at the ones that have struggled this month as well. And once again, we got single stocks at the single stock ETFs at the top. We got single stock ETFs down at the bottom. you're not going to find many diversified funds at the bottom. They're going to kind of hang out more towards the middle. Now, my favorite part of looking for performance, looking for opportunities, like it's nice to look at the 1 week how it's done, the 1 month how it's done, but it's really the 6 month. That's where I feel like it's much more relevant to our most current economic cycle. Right. Whereas if you go a little bit farther out now, you might be incorporating other economic cycles. So 6 month, we get a good idea of just, again, what funds have done well. Well, a lot of the CoveredCall ETFs are, once again, single stock. There's probably more single stock ETFs than there are diversified funds. And if they are specific to the NASDAQ 100 index or the S&P 500. So as we go down the list here, the diversified funds hang out in the middle, and the single stocks are more towards the very bottom or way at the top here. But if you're looking for opportunities, this is where you're going to. You're going to go to the bottom once you filter it in the 6 month tab, and then just head over to what sectors have actually done that have done poorly. Well, in this case, we got technology, but it is kind of skewed by the fact that, again, these are just single stock ETFs. Once again, the yield max stuff. Some of these funds just taken a bit of a beating, but once I incorporate total return into this, I think that you'll probably look at the funds a little bit differently, just because these funds they're not really geared towards, and not at all geared towards price performance. Now you might get some outliers here at the top. We do see some yield max a little bit at the top here with price performance, but these are income driven products. They are meant to pay out. You maybe reinvest a little bit more. It's just a different way of getting a return and compounding over time. But once we incorporate total return, we'll have a much better idea. You won't look at these funds in the same way as, maybe a bit of a as the shock value of just seeing, oh wow, this fund is down 35%. That's not the case. When we incorporate the dividend into it, it cushions that blow, and it could very well be doing even better than, say, just being stable at 0%. It could be totally up if you reinvested all your dividends into it. But anyway, maybe there could be opportunities there with the yield max and some of the defiance stuff as well to jump into over the last 6 months. If we filter by year to date, once again, well, I would say over the last 6 months and year to date is fairly similar. So yeah, you'll see much more of the same funds there at the bottom. If we go out to 1 year, what's at the bottom over the course of 1 year? You do see a couple more diversified funds like XYLD, ROYLD. What are these funds? What's the price performance of these funds? Yeah, down 2%, down 9%, right? And again, with ROYLD, they focus on small cap stocks. So stocks that are going to be a lot more volatile, don't have the same kind of brand recognition as, say, companies within the S&P 500. Hopefully you enjoyed that small snippet from the CoveredCall ETF ALLSTAR tracker. There is a 2.5 hour video on my Patreon specifically for members if you want to absorb a full month's worth of content here in June of 2024. So as a reminder, you want to check out the CoveredCall ETF ALLSTAR tracker for yourself, head to the description below or the first comment that you see, and you can research the tracker through that. So with that being said, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.